Welcome back to our weekly options education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. Let's go ahead and get started here. Today we're going to be talking about how to trade debit spreads. This is really designed to provide you guys with an option strategy that allows you to take a directional view, either bullish or bearish, on any stock or ETF with as much efficiency as possible. And what I mean by that is learning to basically maximize your profits by limiting your risk, because debit spreads allow you to take that directional view with the substantially smaller amounts of risk compared to other option strategies. And that's why debit spreads is one of the best strategies to use when you have a directional view on any stock or ETF. So today we're going to break down a few things. We're going to break down the debit spread, what it is, how to trade it, and more importantly, what we're going to do is we're going to show you some real examples of stocks that are potentially going to have some large moves coming up, and what you can and how you can utilize debit spreads to maximize your profits from those strategies. So today we're going to go over a few different things, but before I do that, I just want to remind everyone here at Firstrade, you have $0 commission trades on all stocks, ETFs, options, and mutual funds. This is going to have the largest impact on your bottom line for options trading, because historically options trading has a higher commission schedule than stocks and ETFs. And you're trading a smaller dollar amount when you're trading options, which means a larger percentage of your trade is going towards paying commissions. So with the new Firstrade commission model of 0 commissions on both the base and the per contract piece of your options trade, you are going to have the most efficient trading possible with $0 commissions. So that's one of the greatest things about trading options here at Firstrade. It's also rated Kiplinger's #1 online broker in 2018, voted #1 for ETF and bond investors. Keep that in mind. And what we're going to do is we're going to show you Options Play, which is free of charge to Firstrade customers. So really, this is designed to give you guys the best user experience with Options Play technology to show you how to utilize options efficiently for your trading portfolio, and then having $0 commissions to trade your options so that you have the least amount of your capital going to paying commissions. So like I said, today we're going to go over what are debit spreads. More importantly, when should you use debit spreads? This is a strategy that I do see some people misusing sometimes. So we want to make sure we understand when is the ideal time to enter a debit spread, how to trade debit spreads effectively, talking a little bit about the best practices for how to set up a debit spread, and then most importantly, in my opinion, is the debit spread strategy management, meaning once you're in a trade, how can you actually manage the trade properly once you're in that trade, and what are the things to look for in terms of managing that trade. So those are the things that we're going to go over here today. Like I said, what I really want to do is spend only about 15-20 minutes on the slides talking about these 4 bullet points. But most important of all, what I want to do is actually show you how to utilize Options Play, which is a tool that you guys all have access to free of charge here at Firstrade, and make sure that you understand how to utilize this tool. I'm going to go through some real examples and some real stocks so that you can see how we utilize this tool so that you become self-sufficient in utilizing Options Play to do your own analysis even when we're not teaching you here. So I'm going to start off by talking about what is a debit spread. There's 2 types of spreads that you can trade, debit and credit spreads. Today we're focusing our time on debit spreads. Debit spreads are relatively easy to remember if you're familiar with trading calls or puts, because the bullish debit spread is the bull call spread. The bearish debit spread is the bear put spread. Just like buying calls if you're bullish or puts if you're bearish, debit spreads are the same. The only difference between a debit spread and buying a call or a put is that instead of just outright buying a call or a put, you're actually going to sell another call or a put against that. So we're going to go through an example here just to illustrate for those of you that are brand new to debit spreads, how to construct them. And for this, I'm actually going to use a fictitious stock, XYZ, trading at $100. I typically hate using these types of theoretical examples because it's difficult to go from theoretical to actual trading when you're doing this. But from this purpose of understanding how to construct them, stock XYZ is usually a better example here. Now, the benefit of trading a debit spread, before we go into what they are and how to construct them, is really because debit spreads give you defined risk and reward. If you ask a good trader how they manage to become consistent and how they're able to be profitable in the long run, they'll always tell you that they do it by managing risk. So debit spreads is one of the great ways to allow you to take that directional view while maintaining limited risk. So debit spreads give you limited risk and reward when you go into a trade, so you know exactly what you can expect in terms of max reward and max risk. And that really helps you set up your trade and take the emotions out of the trade, because you already know what your best case scenario and worst case scenario is when you enter that trade. So nothing comes to you as a surprise. And that, I think, is one of the reasons why it's one of my favorite strategies and really allows me to take a directional view with limited risk. So we're going to look at stock XYZ trading at $100. Let's say we're bullish on this stock. It's trading at 100. We think it's going to go to 110 or 115. How do we set up a debit spread for that? So this is where we're going to, just like buying a regular call, we're going to start by buying a 100 strike call, an at-the-money call. Let's say this call cost us $4. So instead of just buying an outright call, which is traditionally what you would do if you're just buying a call option, now what we're going to do is we're going to sell a higher call against that. And what that does is it brings in a credit. So let's say we sell the 110 call against that 100 call that we bought. So now we're going to receive a $1 credit for selling that 110 call, which brings our total cost, instead of $4 for the trade, down to $3. So now we've reduced our max risk from $4 by buying the call option down to $3. So we've decreased the cost of getting into the trade. We've decreased our risk, which also means that we can potentially increase our reward. So the distance between the two strikes, buying the 100 strike call and the 110 strike call, that's a $10 wide spread. So whenever we're talking about spreads, the width determines the opportunity here, and whatever is our max risk, the rest of that is our max reward. So because we have a $10 spread and we're paying $3 for that spread, our max reward here is $7. Notice how I'm risking $3 to try to make $7. This is the type of risk-reward ratio that you'll typically see when you're trading debit spreads. And that's one of the reasons why I like trading this strategy, because I can risk a small amount of money to try to make a larger amount of money if I call the direction of stock XYZ correctly. Conversely, on the downside, if I'm looking at stock XYZ and I think it's going to decrease in value, I think it's going to go down to 90 or 95. This is where I'd be trading a long put vertical or a bear put vertical. So here, what I'm going to start off is buying a $100 put, similar to anyone who's buying a put. Let's say this put cost me $4 to buy this put. Normally, that's what I'd be paying, $4. That's my absolute risk, and I get downside exposure if the stock XYZ goes lower. But now with the put vertical, what I'm going to do is I'm going to sell a $90 put against that. I'm going to collect, let's say, a $1 credit again for that $90 put. So now instead of paying $4 for an outright put, I'm only paying $3 for the whole spread. So again, that brings my max risk down to $3 instead of $4 with the put. And again, because the distance between the two strikes of a $100 put and a $90 put is $10, that relieves the remaining width to be my max reward. So if I'm paying $3 for that spread, it's a $10 wide spread. That leaves me $7 worth of potential reward on that trade. And the goal for these two strategies is to basically profit from a large directional move in one direction or another. That's really the key here, is being able to define your risk and still take advantage of a large directional move, either higher or lower on the underlying stock. So debit spreads, generally speaking, now that we've talked about how to construct them, I want to talk about some of the other aspects that you need to think about with debit spreads. So first of all, debit spreads, generally speaking, are better for trading individual stocks versus trading ETFs and indices. And the reason for this is really because individual stocks tend to have larger moves. You know, ETFs and indices, because they account for a large number of underlyings, they tend to have smaller directional moves, or they certainly don't have as many jumps or gaps higher or gaps lower because they've diversified away the single stock risk. So debit spreads, generally speaking, because they take advantage of large moves, tend to work a little better on individual stocks versus ETFs and options. When we're talking about expiration dates of debit spreads, you generally want to have at least 5 to 8 weeks from expiration, if not longer. And the reason for this is really because longer dated options minimize theta or time decay. Time decay is what works against us when we're long options, and debit spreads are considered a long option strategy. So we usually want to buy a longer dated option. Even if we're only in the trade for a couple of weeks or 3 weeks, you can always buy a 2-month option and sell it 3 weeks into that trade if you're profitable or even at a loss. So you don't have to hold the trade all the way to expiration, but you generally want to buy something that's at least 1.5 months out from expiration. And when it comes to strike prices, we usually start by buying a slightly in the money strike. Whether it's a call or a put, you want to buy one that's slightly in the money, and then you want to always sell a strike that's out of the money. And we're going to go over kind of which strikes are optimal for this, but that's the general rule of thumb. The long leg should be slightly in the money, and the short leg should always be out of the money on a debit spread. So what I want to do now is just to go through a few different things that people have brought up in the past about debit spreads. Debit spreads traditionally have lower probability of profit, and people have always told me, hey, why would you ever trade something that has a low probability of profit? And the answer is, in order to understand probability of profit, you really need to understand what the trade-off between all option trades is. And that's the trade-off between probability and risk to reward. So a lot of people will say, hey, debit spreads have 30, 40, 45% probability of profit. That doesn't sound as good as when I sell credit spreads or other strategies that I have 80, 90% probability of profit. But I think what people who ask me that question are not seeing the full picture. They're not understanding that the other half of the equation is risk to reward. So when you have low probability, you're going to have high risk to reward. When you have high probability, you're going to have low risk to reward. So it's really important to understand that. So a lot of debit spreads where you're trading near the money strikes, we'll see probability of profits that, around 35, 40% is usually normal. And what you're typically doing is you're risking roughly, let's say $200 to try to make roughly $500. So about a 2.5 to 1 risk to reward ratio. That's typical of what you would see on most debit spreads. You can trade credit spreads that have 80 to 90% probability of profit, but many of those trades you're risking $900 to make maybe $100. So it's not like one's better than the other. The question is just, what do you prefer? Do you prefer to win less, but when you win big amounts? Or do you prefer to win all the time, but every time you lose, you wipe out 6, 7, 8, 10 trades previous to that? So it's really dependent on kind of what your preference is. One's not better than the other. What I think is far more important in helping you decide whether you trade debit and credit spreads is something we're going to cover in the next couple of slides. Is really understanding when is the ideal time to enter debit spreads, when is the ideal time to enter credit spreads. You shouldn't always just trade debit spreads or just trade credit spreads. You got to combine the two because they are used for different environments. So you can also trade really far out of the money debit spreads that have only 15, 20% probability of profit. These will come with really high risk reward ratios. So you'll be risking $100 to try to make $900. I mean, there's certainly not the same odds as buying a lottery ticket, but it's that same kind of concept. You're really going for something that has a low probability, but if it does work out, you get paid a lot. So it really depends. Understanding the trade-off between probability and risk reward is really important in helping you decide which strategy is best suited for you. So what are the optimal debit spreads? We back-tested this strategy across thousands of signals that we've gotten to buy or sell a certain stock. And what we did is we compared buying the stock to buying a debit spread. And what we found for debit spreads is that you always want to buy a slightly in the money call, about a 50 to 60 delta call this is not just calls, this is calls and puts. So either buying a 50 to 60 delta call or put and selling the 10 to 15 delta call or put against that. That is what we find to be the optimal debit spread for trading. That really lowers the cost of that trade while keeping the upside. And the rule of thumb here is, generally speaking, that when you're selling a 15 delta call against a 50 or 60 delta call, you're going to roughly bring in about 10 to 20% of the premium of that long leg. So if you pay $1 for the long leg, you'll usually collect anywhere from 10 to 20 cents on the short leg to offset that dollar you're paying for that long leg. And these types of trades with the 50 to 60 delta call versus the 10 to 15 call that you're selling against that will usually result in trades that have roughly 33% winners, 35% winners in that range, with about a 2 to 1 risk to reward ratio. Those are the types of metrics that we typically see with what we consider the optimal debit spread. And the reason that, again, I want to reiterate why we want to trade debit spreads converse as opposed to just buying a call or a put. Number one, you lower your risk compared to just buying a call or a put. Because you've lowered your risk, you have a better break-even price, so the stock doesn't have to move as far in order for you to be profitable. And lastly, because you have a short leg as part of your strategy, it lowers the time decay, lowers the theta of the overall strategy, so you can stay in that trade a little longer, or the effect of time decay is not as fast on your spread as it is on a long call. So that's really the reasons why you should consider taking a look at debit spread. If you currently buy calls or puts, take a look at debit spreads as an alternative, because there's quite a bit of benefit to buying a debit spread compared to just outright buying a call or a put. So next, I want to cover a really important topic, and this is when to use a debit spread. This is probably one of the most critical pieces to what I'm going to teach you guys today, because there's lots of places that will teach you how to buy a debit spread or how to construct a debit spread. The research on kind of what are the optimal credit spreads is not proprietary to Options Play. However, one of the best things that I think that I can help provide you guys with is really understanding when to utilize them, because it's not used for all purposes. Number one, debit spreads are only useful when you're expecting a large bullish or bearish move on an underlying stock. And I emphasize the term large, meaning if you're expecting a stock to move 1 or 2%, this is not the strategy for you. And I'll show you really quickly with some examples why the debit spread is not suitable if you're only expecting a modest move. This is really great for if you're expecting a breakout or a breakdown. So these are typical technical analysis functions when you typically see large, quick, fast moves is when a stock breaks out or breaks down. So those are ideal for trading debit spreads. When relative strength and trend line up is another good time to use debit spreads. So when you have a strong stock and a bullish trend and it's triggered some kind of buy signal, these are the types of trades that give you high probability, high return trades. These are useful for debit spreads. And most importantly, do not use debit spreads when you're expecting a modest move. I can't reiterate that enough, and I'm going to show you a chart on the next screen to really emphasize this. And again, just to reiterate, if you're bullish, you want to trade a long call vertical. If you're bearish, you want to trade a long put vertical. Okay, so next what I want to do is I want to show you the difference between breakouts and trading debit spreads versus overbought and oversold conditions for trading credit spreads. So as you can see here, I have a chart of a stock that kind of was trading within a tighter and tighter range into a triangle and finally broke out around this 99 level and quickly ran all the way up to about 105 over the course of just a month or so. These are the types of breakout opportunities that you want to potentially enter a debit spread on, because they're going to be able to take advantage of these types of fast directional moves in one direction or another. Conversely, when a stock is range bound and it ranges between overbought and oversold, many of you guys use these technical indicators like stochastics, RSI, MACD to identify overbought, oversold signals. These are not ideal for debit spreads, because these overbought, oversold signals certainly tell you that the trend or momentum is reversing, but it doesn't give you an idea as far as how far it's going to go. So when a stock is oversold, you don't necessarily really have an idea as far as how far it can go higher. You can use previous resistance levels as a template, but as you can see, there's plenty of examples where the stock is oversold and all it does is it just stops it from going lower. It doesn't really move much higher. It only moves maybe $1 higher. Multiple times does this stock become oversold, and just instead of moving any lower, it just moves slightly higher. Versus conversely, same thing when the stock is overbought. As you can see, it only moves a couple of dollars lower. So for these types of conditions, you don't want to use debit spreads. You want to use credit spreads. So we actually have a whole separate webinar just on how to sell credit spreads. And notice the one thing about credit spreads is that you can sell credit spreads over and over again on the same symbol, versus on this entire chart, there was only really one opportunity to potentially get into a debit spread. So that's why debit spreads are trades that you typically make on different stocks all the time, because you could only identify these types of breakouts from time to time, versus credit spreads is something that you can trade over and over again on the same symbol. So if you're trading debit spreads, you're typically trading lots of different symbols. When you're trading credit spreads, you tend to be trading fewer symbols. Just distinction between trading debit and credit spreads, and by putting the two side by side, I hope that makes it clear that you should only use debit spreads when you expect a large directional move. If something's just oversold and you think it'll correct a little or stop going any lower, those are not good opportunities for debit spreads. So how do you trade debit spreads effectively? This is really where risk management is key. You want to time your entry strategy with an expected large move. That's what we just spoke about in the last slide. When you expect a large move like a breakout or a breakdown, that's when you want to enter a debit spread. When it comes to exiting your trade or how to manage your trade, this is really where, in my opinion, debit spreads are quite clean in understanding how to manage them. Unlike credit spreads, which there's a lot of other factors that you got to put into account for, debit spreads are really easy to manage. So you want to cut losses if the move that you expect doesn't materialize. So if you're looking at this large move and the stock breaks higher and then just kind of keeps going sideways for half a month or so and you don't really get this quick, fast move, always get out of the trade, especially if the move that you're expecting does not materialize. Now, the one key difference between debit versus credit spreads is that debit spreads you almost always exit before expiration, meaning this is not a strategy that you typically want to hold to expiration. Just like buying a call or a put, you never want to hold the buying a call or a put to expiration. Same thing with the debit spread. And when should you cut your losses or get out at a gain? This is really where, again, it's pretty simple, because regardless of how much your spread costs, regardless of whether it's a conservative or aggressive one, or it's a call or a put, it doesn't matter what strikes you use. The rules are always the same. And again, this is why it's one of my favorite strategies, because they're easier to manage. You want to cut your losses if you've lost more than 50% of the trade that you've purchased, and you want to take profits if you reach 75 to 100% gain, or at least partial profits at that point. So if you paid $1 for a debit spread and you're down to 50 cents, that's when you want to cut your losses, when you've lost 50% of the dollar that you've paid. On the upside, if you paid $1 for a spread and it's now trading at $1.75 or $2, that's when you want to get out at a profit. And that's really the rule of thumb that you want to use for trading debit spreads. So with that, what I want to do is, now that we've covered what debit spreads are, why they're efficient, when you should utilize them, and how you manage them, I want to go through some real examples that's going to help drive the point home as to how you can utilize these tools to look for some specific strategies. So first, before I launch into anything, I would just want to show everyone, for those of you that are brand new to options play or brand new to Firstrade, you can find the options play tool under your options trading tab. Once you're at the options trading tab, all you have to do is hit the options wizard, and that brings together the options play tool. Now, the reason we created this tool was because when we started trading options, we realized this is the type of page that you're used to looking at, right? There's a lot of information on here. There's a lot of numbers. Chances are, if you're brand new, it's difficult to understand where to start. Even if you know how to navigate these types of pages, sometimes where you start is just basically an educated guess. And what you do is you guess, and then you do some analysis, and you say, maybe that's not what I want, so that you go back to an option chain, you pick another strike or another expiration date, and there's just a lot of trial and error here. So what we wanted to do is give you definitive starting points, regardless of whether you're bullish and bearish, and show you analytics so that you can really definitively hone in on which strategy is best suited for you. So the platform itself is divided into 3 sections. You have trade ideas and watch lists here in the middle, as you have a security analysis panel here in the middle, and we have trading and income here on the right-hand side. So these 3 panels give you what to trade, but based on your trade ideas and watch list. The middle panel tells you why you should trade it, with technical analysis and relative strength indicators that give you an idea as far as the bullish and bearish trend and strength of the stock, along with earnings, dividends, and price action data here at the bottom. And lastly, once you have your directional view on the stock, how can you take advantage of that trade? Are you bullish? Are you bearish? We present to you strategies as opposed to asking you to find them or select ones yourself. So here I have Apple up here, and I'm just using Apple for illustrative purposes. I don't have a particular view on this specific trade, but basically what this allows you to do is type in any symbol, look at the current technical analysis to say, is this bullish or bearish? This happens to be one of the strongest stocks in the market right now, so I'm certainly going to be looking at perhaps bullish opportunities on the stock, especially in the grander context of technology really selling off for the last few weeks. Apple really hasn't sold off a lot, which shows me that this stock has high relative strength going into earnings in a few days. I think there's a fair chance that Apple may beat earnings like we saw in Netflix, like we saw in a few other tech names. I think that if it does beat on earnings, it can easily go back up to this 233, 235 level. So I'm going to take a look at earnings as a catalyst for perhaps Apple moving back higher to that 52-week high around 233. So as you notice here on the bottom of my screen, I have two buttons. You can click on I'm bullish or I'm bearish. So I'm going to use I'm bullish because I want to look at 3 bullish strategies on Apple. And after this, we're going to look at some bearish strategies. So when I click on I'm bullish, I get 3 strategies. I can buy the stock, which costs me 22 grand. I can buy a call option, which costs me 920. So a fraction of what it costs to buy 100 shares of the stock. I get the same upside or similar upside rather, with limited risk to the downside, versus the spread. This is the debit spread that we've just learned about by buying the 222.5 call like we have here in the middle, but we're selling a 245 call, a higher call against that. So instead of paying 920 for that call, we're only paying 784 for the whole spread. So let's actually see how the strategy will perform and Apple goes higher to 233. So let's say the stock goes to 233. I talked about this perhaps making that move fairly quickly after earnings. So earnings we know is on November 1st. So let's say this on November, 20th moves up to 233. I should also probably account for the fact that volatility will likely come down a little bit after earnings, but that's a little bit more advanced for this specific topic. But what this allows me to do, number one, is provide you with starting points so that you don't have to pick expirations and strike prices to explore and learn, especially for those of you that are new to options. But more importantly, giving you metrics so that you can see exactly how these strategies perform and you don't have to guess or estimate how they'll perform if the stock goes higher. So as you can see, if the stock goes to 233, even at expiration, if I bought the stock, I make a 4% return. If I bought the call option, I make a 14% return. If I bought the spread, I make a 33% return. So in my opinion, none of these numbers look particularly attractive. So what this is telling me is that if I think the stock's going to go to 233, number one, maybe my best trade here is the debit spread, but this also means that if I'm wrong on this trade, I'm not making as much money versus the amount of money that I'm risking, because Apple could miss on earnings. It could go back down to $200. And if it did that, if I bought the stock, I'd lose $2,300. If I bought the call, I'd lose $920. If I bought the call, I'd lose $784. So I do still risk the least amount of money here. But if the stock goes to 233, I'm only making a 33% profit. So I'm making $266 versus risking $784. In my opinion, this is not a super attractive trade. And granted, the move from 220 to 233 is not a big move for Apple. So this stock really needs to move a little higher before these strategies, look more attractive. So unless you think the stock's going to go to 240, you make a 7.5% return on the call, 7.5% return on the stock, 90% return on the call, 123% return on the call vertical. So at this point, that's when these trades start to look a little bit more attractive. So not only can this tool tell you, hey, how will a strategy perform if it goes to the expected target that you want, but more importantly, it can also tell you how far does the stock need to go before these strategies even make sense for me. So in my particular case, if I'm looking at Apple and I think it's going to go to 233, I probably wouldn't trade these. It's just not large of enough move for me to take on that kind of risk. But if I do think it will go up to 240, then it makes sense for me to consider utilizing options as a viable strategy for this trade. So it's really important not only to understand what are your potential rewards, what are your potential risks, to help you define which strategy is best suited for you, but also helping you understand how much money can I make. And if that money is not large enough, that should persuade you to not look at options. Because as much as I'd love for you to all trade options, at the end of the day, not every single strategy makes sense. And the only person that can make that decision is you. And we're providing you with the analytics so that you definitively know what your expected profit is, what your expected losses are, so that you can make that decision for yourself and you don't have to rely on anyone else to tell you whether it's a good trade or not. These are the tools that professional traders will use to determine, am I getting enough reward for the risk that I'm taking? And lastly, if let's say you do decide that you think that Apple can go to 240 on earnings and you think that this strategy here on the right is a trade that you want to make, one of the best parts that we've done with the Firstrade integration is we have a button here that says preview order that will actually pre-fill the order ticket for you. We also have a strategy checklist just to make sure you understand the risks that you're trading. Are you trading of the trend in the stock? Are you trading the trend in the market? How's the options play score? Is there earnings between now and expiration? And lastly, spread and liquidity. And if everything checks out and you're ready to place that trade and you're okay with all the risks, all you have to do is hit the preview order button, and this will actually pre-fill the ticket for you. So everything from buy to open, number of contracts, symbol, expiration date, strike price, call or put is all pre-filled for you, including a net price, so that you can send this off for execution instantly. This is designed so that you don't have to potentially make any mistakes filling out any order option entry screens. This does all that work for you. So what I really want to do now is just go through a few more examples. I want to look at some stocks that have really started to fall apart, look at some bearish opportunities, show you how you can utilize debit spreads for bearish opportunities. And the reason I want to do this is because for those of you that are not using options today, you're probably not even looking for bearish opportunities, because in order to take advantage of a bearish stock, you have to short that stock. And many of you may not have margin accounts. You may not be able to borrow that stock. You may not want to pay margin interest to borrow that stock. There's a lot of limitations that prevent you from potentially shorting a stock that you don't have the same limitation when you're trading options. So it doesn't really matter which symbol I use here. I've just pulled up Micron Technology. I don't have a specific view on this particular strategy here, but any bearish trade here makes sense. This is a bearish trade that we looked at yesterday, public storage rather. As you can see, it broke below 200 support, started to turn over, bought again, and it started to turn lower. So we were looking at a bearish opportunity on public storage. Doesn't matter what stock you put in, as long as you're bearish on that trade, you can click on I'm bearish. And what we're going to do is we're going to show you 3 bearish opportunities. You can short the stock, you can buy a put option, or you can buy a put spread. So this is the debit spread that we're talking about here. So if I'm looking at public storage, I see that the next support level is down here around 180. It's got earnings in a couple of days. So maybe I do think that there's a chance that this stock will tank on earnings, and I want to play that, right? So if I shorted the stock and this stock went down to 180, I make a really nice 8.7% return. But the problem with shorting a stock is that you have unlimited risk, and we're going to explore that here in 1 second. But if I bought this put option for 880, I make 127% return versus an 8% return. And then if you look at this vertical here on the right, I'm looking at 181% return versus 127% return. So this $170 deduction that I'm making from paying just an outright put versus a put spread increases my return by almost 60%. And that's really the key of why debit spreads allow you to really take that directional view as efficiently as possible. And at the same time, let's say I'm wrong. Let's say public storage really beats earnings and goes back up to 220, which is where it's just at. A few weeks ago, here, if I had shorted the stock, I lose roughly $2,400. So I'm risking quite a bit by shorting the stock. If I bought the put, I'd lose $880, so a fraction of that, roughly a third of the losses that I have with shorting the stock, versus buying a put vertical, I'm only risking $710. So not only am I getting the highest return if I'm right by buying this put spread, I'm also risking the least amount of money if I'm wrong on this trade. And that's why this strategy here on the right has the highest options play score. It's designed to give you the most efficient risk-reward ratio out of any of these 3 strategies, and the options play score tells you which one gives you a better risk-reward ratio. So if you're comparing other strategies, you want to modify any of these and you want to change to a short call vertical like a credit spread, you can do that and compare different strategies. Even if they're completely different strategies, you can use our platform to compare them. And once you're ready to place that trade, you can hit the trade button, preview order, and again, we pre-fill the ticket for you so that you can send this off for execution immediately. So this is all designed to make your process or research time from looking at a symbol, typing in a symbol, getting a snapshot view of the technical analysis, getting the 1 month and 6 month trend, the relative strength within a few seconds, and be able to decide, am I bullish or bearish on this trade, and instantly be able to see 3 strategies that make sense for your given view. using the P&L simulator, play around with what your expected target price on the stock is. So let's say I want to go contrarian, and I think Micron's actually going to go back higher. I think technology is going to bounce higher. I think it's going to go back up to 47. So what happens if this stock goes up to 47? What do I do? So here, actually, as you can see, if I bought the stock, a 21% return. If I bought the call, a 238% return. If I bought this debit spread, only 177% return. So in this particular case, this is telling me that I should probably trade that call option because I'm super bullish on Micron. I think it can go all the way up to 47. This is telling you, hey, out of these three strategies, you should pick this call. This is something that you couldn't do from just looking at an option chain. You couldn't compare buying a call to a call spread. So if you were really bullish on a stock, it was really difficult for you to say which strategy is best suited for me. With options play, you can definitively see which strategy is best suited for you depending on what your views are, and instantly be able to click on trade, preview order, and send that order for execution. This is designed to make your research time from the underlying stock to finding an option strategy to placing that trade down from a few minutes down to just a few seconds. So for those of you that are experienced options traders, this will save you a lot of time from pulling through option chains manually, going through pages and pages like this. And for those of you that are brand new, this is really designed to help you explore and understand the power of options without feeling overwhelmed or confused by some of these pages and trying to figure out where to start and kind of just stumbling around. This provides you with definitive starting points for both bullish and bearish views on any underlying stock or ETF, giving you all the analytics to decide how much potential reward versus risk so that you can make a decision. And then lastly, allowing you to facilitate that into an actual execution by just previewing the order and placing that order into your Firstrade account commission free. So with that, I just want to thank everyone for taking the time out this afternoon. I hope that I was able to really illuminate the power of options play and how well it works with the Firstrade account. Now that you have zero commissions, you can trade all of these strategies that we talked about at the exact cost that we are showing you on your screens. So most other brokerage firms, you have to also factor into commissions. Here at Firstrade, you don't have to. So the expected profit and loss that you see here is exactly the profit and loss you would actually see in your account if you get filled at these prices. So keep that in mind, and I hope everyone has found this useful. I'll open this up for Q&A at this point. If you have any questions, please type them into the chat window, and I will answer as many questions as I have time for. James, thank you so much. Greg, thank you so much. I really appreciate this. I really hope that you guys find these useful. The question here is the significance of the circles and the columns to the right. So the options play score tells you the risk to reward ratio. So we talked about here, a little Micron here is trading at $38. As you can see, if I expect this stock to really dump and go down to $33, this strategy here on the right gives me the highest return. On the same token, if I'm wrong, this strategy on the right gives me the least amount of losses. So it's really comparing the amount of potential profit versus a potential risk and giving you a metric that allows you to compare the risk reward of different strategies. And that's what the options play score does. Need to find the delta of a strike of a spread before. So first of all of our deltas are already optimized based on what we talked about. So we're always buying a 50 to 60 delta put and selling a 15 delta put against that. So all of our debit spreads are already optimized for you, so you don't have to go and find it yourself. That's really one of the key pieces of options play. What are the circle dots at the right-hand bottom of the page in options play? So the question, I think, is what do these dots mean? These are all different panels to help you better understand each one of these three strategies. So we have a plain English tab for those of you that are looking to learn. We have a risk and investment calculator. This is designed to calculate the number of contracts. So let's say you have $2,000 that you want to risk. You can click on calculate and we'll tell you how many shares or contracts you can buy or sell. Or if you want to look at an investment perspective, let's say you really typically invest $5,000 in the stock. How can you calculate the appropriate number of contracts? So for $5,000, you are able to buy 129 shares, which equates to one contract. We have a trading range simulator that gives you an idea as far as what are the one standard deviation move for any of these expiration dates. So if you're trading different expiration dates, you want to know roughly what is the range that stock will trade in. This is what the trading range simulator will do. And the last dot is simply just edit legs or modify so that you can modify any of these strategies. I think the question is, when do you use a put vertical and when you use a call vertical? That's very, very simple. You want to use a put vertical when you're bullish. You want to use a call vertical. You want to use a call vertical when you're bullish, and you want to use a put vertical when you are bearish on the stock. Nancy, thank you so much. I really appreciate it. I hope you guys find this useful. We built this for you guys to better understand, learn, explore, and really inspire for those of you that are brand new to look at options as another alternative, simply buying outright stock. Because, buying and shorting stock, it's the same strategy regardless of whether you're super bullish or kind of bullish or, mildly bullish. It's the same strategy. With options, you can trade different strategies depending on how bullish you are, whether you're bullish over the next day or next month or next year. Options really give you the flexibility of maximizing your views on an underlying stock. When you're buying a stock, you can only just buy the stock. You can't do anything else. So that's really why we utilize options play to help you better understand each one of these strategies so that you can analyze it yourself and figure out which strategy is best suited for you. Debit spreads and credit spreads are both mixes of buys and calls. I think you mean puts and calls. So credit spreads are basically the exact opposite. Just instead of buying the same strikes, you're selling the same strikes. So here in this example, instead of buying the 100 call, you're selling that 100 call, and instead of selling the 110 call, you're buying that 110 call. So that's how you inverse a debit spread to a credit spread. If you've missed that webinar, I highly recommend you to watch the webinar recordings on credit spreads, and that will show you how to utilize them. Again, I just want to thank everyone for taking the time out this afternoon. I hope you guys find this useful. And we're back on a 2-week schedule for these webinars. So we'll be doing these every 2 weeks with different topics. So if you've missed one in the past, don't worry. We're going to keep doing these going forward so that you guys continue to get options education from Firstrade and Options Play. So thank you very much. I hope you guys have a great afternoon, and I'll see you guys in 2 weeks.